Hello everyone, hope you're good, hope you're well. Okay, so we'll be talking about fiscal policy and government spending. Let's get to it. So what is fiscal policy? Well, fiscal policy involves the use of changes in government spending and the taxation and benefit systems to influence the economy. So what are we saying? We're saying we're trying to influence the economy, right? And how can the government do this? Well, government could increase its spending, say, to stimulate the economy, or reduce spending to slow things down. They could tax households, corporations more. If they do this and there's less money to spend, they could tax less to do the opposite. Or they could increase benefits, say, to stimulate spending or reduce it to force people to work and, things like that. Okay, so we could use fiscal policy to affect both aggregate demand and aggregate supply. And we'll see this in a minute. All right, so here's an example of how we can use fiscal policy to affect aggregate demand and supply. So in the first diagram, diagram A, we increase government spending and that affects aggregate demand. So we increase government spending and aggregate demand rises from AD1 to AD2. And what do we have? We have a price increase from P1 to P2. And we also have a rise in output from Y1 to Y2. How about in diagram B? What we have is we affect aggregate supply by, say, reducing the tax rate and the benefit system, which makes it more attractive for people to go to work. Okay, so we reduce the tax rate and more people get into work, or we reduce the benefit that we give people who are off work. And what does that do? It makes it more attractive for people to go to work, so it increases the incentive to work, and then this increases aggregate supply from AS1 to AS2. So remember, we said fiscal policy involves the use of changes in government spending and the taxation and benefit systems to influence the economy. Well, what can the government spend on? The government can spend on things like defense, so the military, social security benefits, so maybe unemployment benefits, disability benefits, or payments we give to people if they're ill, or maybe older people, and maybe spending on education. So the government can spend on schools, universities, colleges. The government can spend on infrastructure, roads, bridges, things like that. Maybe the NHS. Or government could repay previous borrowing. So maybe government's borrowed money in the past and we need to pay that, so pay the interest and also pay back on the capital that was borrowed before. 4. All right, now we've talked about government spending. Let's go ahead to talk about taxation. So what is a tax? A tax, from the Latin taxo, is a mandatory financial charge or some other type of levy imposed upon a taxpayer, an individual, or other legal entity by a governmental organization in order to fund various public expenditures. So what's happening here is the government is imposing this levy upon this taxpayer, which could be a person, could be a household, it could be a corporation, in order to fund public expenditures. Now, if this tax is not being used to fund public expenditures, then it's not a tax, it's extortion. A failure to pay a tax, along with evasion of or resistance to taxation, is punishable by law. Now, taxes consist of direct or indirect taxes, and we'll talk about both. So what is a direct tax? A direct tax is a type of tax where the incidence and the impact of taxation fall on the same entity. So note the keywords here, where the incidence and the impact of taxation fall on the same entity. All right. So in the case of a direct tax, the burden can't be shifted by the taxpayer to someone else. So if you're taxed a direct tax, you can't make someone else pay it. All right. Let's have some examples. So direct taxes are usually paid on households' incomes and firms' profits. Like, for instance, your income tax, right? So you get taxed on your income. You can't make someone else pay that, right? It's the final value of your income. Or on your corporation tax. So this is taxes paid on firms' profits, or capital gains tax, for instance. These are taxes you pay when you sell assets like shares or houses that have gone up in value. Or your inheritance tax, taxes you pay when you inherited income and assets. You can't shift this. Or your national insurance taxes. So these are payments made by individuals and their employers to finance pensions and social security. So the main thing and the main difference between a direct tax and an indirect tax is, with a direct tax, the incidence and the impact of taxation fall on the same entity. With an indirect tax, which we'll go to next, you find that the incidence falls on one person, but the impact falls on someone else. So what happens with your indirect taxes is, if you tax someone, this person could make someone else pay it by, say, increasing the price of the commodity when they sell that on. So the incidence falls on someone, but the tax impact actually falls on someone else. And let's see an example of this. So let's take a look at indirect taxes. Now, an indirect tax is a type of tax where the incidence and the impact of taxation does not fall on the same entity. In the case of indirect tax, the burden of the tax can be shifted by the taxpayer to someone else. So an indirect tax has the effect of raising the price of the products on which they are imposed. So look at what happens in the case of an indirect tax. Say I charge a corporation £5 for selling a particular item. Okay? Now, imagine, if you will, if the price of that commodity was £100, and now I, the government, come and I say, I'm going to charge you £5 extra. What this corporation could do is just to increase the price of this commodity to, say, 105, or if they're particularly, feeling frisky, they can increase it by as much as they want, right? And what will happen? What will happen is, the final person who paid this tax amount is not going to be the corporation who's selling. So remember, I taxed the corporation this £5 here extra, but all the corporation has done has been to increase the price. So the final incidence falls on the customer who is buying that product. So indirect taxes are usually incurred when items are purchased. The producer is legally obliged to pay these taxes, but adds them on to the price to try and pass them on to the customer. For example, your value-added tax. So this is paid when most goods and services are bought, for instance. Your excise duties. These are paid specific taxes for particular goods and services such as alcohol, and your customs duties. So when you import goods into the country, you pay a tax, and you could just increase the price of the final commodity, so the final customers who are buying these items pay the value of the tax. So what are the different types of taxation systems? Well, we have three types of taxation systems: a progressive type, a regressive type, and a proportional type. Let's start with a progressive type. In a progressive taxation system, the average rate of tax increases as people earn more money. So you earn more and you pay more. In the regressive taxation system, the average rate of tax falls as income increases. So you earn more and you pay less. In the proportional tax system, the average rate of tax is constant regardless of what people earn. Let's have an example. Let's have individual A, B, and C. Let's have individual A making the most amount of money, say £10,000. Individual B earns £1,000, and individual C earns just £100. Now let's have your progressive tax system. Let's have your regressive, and let's have your proportional. Okay. Now, in your proportional tax system, we should probably start with that because that's the easiest. Each individual would pay 10%. Right? However, in your progressive tax system, we'll look at individual A and say he earns the most. We could probably charge him 30%. We'll say individual B, you earn less, we'll charge you 20%. And individual C will probably charge 10%. In your regressive tax system, we'll see that individual A would pay the least amount of tax percentage, and individual C will pay the most. Why? Say, for instance, we decide to impose a flat levy of, say, £10 on each of them. What will happen is individual C will end up paying 10% of his income. Individual B will pay 1%, and individual A, will pay 0.1% of his or her income. So we see there that the average tax rate falls as income increases. So you earn more, you pay less, and you earn less, you pay more. In relation to your income, so your tax rate, we've shown this here nicely on this graph with your progressive tax system, proportional tax system, and your regressive tax system. You can see that your tax rate is constant regardless of income. With your proportional tax system, you can see that your tax rate increases the more you earn. With your progressive tax system, and you can see that your tax rate reduces the more you earn with your regressive tax system. Now, the tax debate is a very emotive one. Lots of people have different ideas about this. Lots of different opinions abound about this. Lots of politicians, lots of political parties, lots of people, lots of leaders have different ideas on how taxes should be run. But we like to think of what we call a fair tax system. And that should have certain features. So features of a fair tax system are horizontal equity. So people in the same situation should pay the same amount of tax. It makes sense, right? We're in the same situation, we should pay the same amount of tax. And vertical equity is the second feature of a fair tax system. So taxes should be fair between different income groups. So between the rich and the poor, between, say, those who earn 1,000 to those who earn 10,000 to those who earn 100,000, right? So should be fair. In addition, it is beneficial for every government to have an effective taxation system. Now, what are the features of an effective taxation? Some features of an effective taxation are that it is understandable. It should be easy for you and me to calculate our taxes. We should understand what our taxes are and maybe why we're being charged these taxes. It shouldn't be too difficult to calculate this. It should be cost effective to administer taxes, right? So the benefits of the taxes should outweigh the costs. If it costs more to administer these taxes, if it costs more to collect these taxes, then what's the point? it should be difficult to avoid paying taxes. And this is why your taxes are usually taken from your pay before you even get your pay. So you usually see this on your pay slip. Now, this is important for certain reasons. If people think they can avoid paying taxes, human nature, many people will. And when good people see that other people avoid paying taxes, they'll feel cheated and they'll want to opt out as well. So it should be difficult to avoid paying taxes. And it should be non-distortionary. So our taxes shouldn't make us go into habits that are bad. For instance, we shouldn't tax good commodities, and this should force us, make us consume commodities that are bad for us. Okay? Your taxes shouldn't mess with your demand and supply equilibrium, your micro equilibrium, your macro equilibrium. Because if this happens, then the free market will be violated. All right? Now, it's also important to note that there are certain ways to actually reduce your tax burden. The legal way to do it is by what we call tax avoidance. All right? So legal steps to avoid paying as much taxes as possible, we call these tax avoidance measures. For instance, going to see your accountant or going to see a lawyer and doing a self-assessment to reduce your tax burden. This is perfectly legal. You can do this. However, tax evasion are illegal ways to avoid paying taxes. And this you don't want to do, ladies and gentlemen. This is what happened to Al Capone and why he was locked up. So if you're supposed to pay tax and you evade your taxes, that is bad. So here we have this beautiful graph illustrating the relationship between government budgets and deficits. So we have our net tax revenue. We have our autonomous government spending. And we see that when our net tax revenue is above our autonomous government spending, we have a budget surplus because we're bringing in more than we're spending, right? Taxes are above autonomous government spending. So that's a good thing. However, we can have a situation where our net tax revenue is below our autonomous government spending. And in this case, we have a budget deficit, right? So more money is being spent than we're collecting, all right? And you could see at zero income tax, right, net tax revenue is negative, right? Why? Because we're still spending, ladies and gentlemen, say on benefits, even though no taxes are coming in. Now, don't forget, ladies and gentlemen, what brought us on to this whole discussion on government spending, taxation, and benefits was our topic on fiscal policy and government spending. Now, we define fiscal policy as involving the use of changes in government spending and the taxation and benefit systems to influence the economy. However, the effectiveness of fiscal policy depends on certain items. For instance, the accuracy of forecasting. So remember, we're trying to change government spending or taxation or benefit systems to influence the economy. But if our forecasts on the economy were wrong, if they were inaccurate, then the influence would also be inaccurate, okay? So our fiscal policy would be ineffective, all right? How about the impact of our policy changes, all right? So think about what happens when we try to influence the economy by increasing government spending or doing something to taxation or benefit system. Well, if it doesn't have a large impact on the economy, right? So government can spend as much, but the multiplier effect is low, for instance, or people don't react to tax changes, or, you know, there's certain external factors, or maybe even our benefit systems are not working, then the impact would be low, all right? Also, the funding for desired spending. So we could want to spend more on government projects, for instance, but do we actually have the money? So there's scarcity issues to be considered. Also, there's very different political views about this. How should we fund government spending? Very emotive issue. And also very different personal views. What should we spend the money on? All right. Also, the funding and the spending may actually create problems. Remember, we talked about the crowding out effect, right? And we said this occurs when the government is involved in the sector and this chases out private investment. So this happens when, say, the government goes into a certain enterprise and the free market can't compete. So the government outspends entrepreneurs, or the government can borrow money at cheaper interest rates than entrepreneurs, and this can crowd out private investment. Now, finally, there are two types of supply side fiscal policies, and they involve policies to boost the labor market or boost supply in the goods market. Let's look at boosting the labor market. Things we could do fiscal policy wise to affect the supply side could involve funding for training and development. So we fund more training and development for people, and they get trained, they can produce more, they can produce better, and this shifts our supply curve to the right. Okay, or we can help the unemployed get back into work. That would also make more people work, increase our supply. We could guarantee a minimum wage, and because of that, people are like, okay, as long as I'm guaranteed this minimum wage, I'm going to go into work. We could reduce income taxes, and that would encourage people also to work. We could try to avoid the poverty trap. This occurs when people give up benefits, and because of the tax that we're taxing them, it makes unemployment better, so they don't want to work, and then they go back into unemployment. Okay, so they're stuck in this vicious unproductive and unpleasant circle of poverty, so we should try to avoid that. Okay, other things we could do fiscal policy wise, we could be boosting supply in the goods market. And how could we do this? We could encourage firms to invest by using tax incentives to undertake research and development, and what will happen is we'll get better technology, and our long run aggregate supply curve, is going to move to the right. Okay, and also we could help startups with advice and financial aid, and thereby encourage new businesses, and this would increase the supply of goods and services in the economy as well. So help our businesses with advice, financial aid, management consultants, ask them to come see me and we'll help their businesses. Okay, all right. So our class activity for the week is an interesting one. All right, so find out what type of tax system we presently use in the UK, and also look around and discuss and maybe think about how we can make the UK tax system fairer. Do you think there's certain things we can do? If you were prime minister, what would you do? If you're president of a country, what would you do to make the tax system fairer? Okay, so our class activity is, what is the type of tax system in use presently in the UK, and how can we make the UK tax system fairer? All right, thank you, ladies and gentlemen. Be good.